Chapter. We're talking real money.
Welcome to Talking Real Money. We're here to help you do better with your money on all ranges of topics and generally more specifically about investing. And we've got some great questions about that and other things today. We've also got a special guest on the podcast. I'm Tom Cock. Don has the day off, and we've got a lot of questions to answer here in just a couple minutes. We'll be talking to Roxy Butner, one of our advisors who's been here before. But this is the topic du jour. The number one question we've gotten from the show over the last 20 plus years is, I just came into this money. What do I do with it? That's the number one question. But the number two is, this just happened. What do I do with my money because this happened or this is happening? That's always up there because there's a lot of things in the news. There's a lot of things to discussion. And we've also been programmed to believe that good investors respond to things or see things coming. And good investment managers can sort of predict the future, even though the academics have showed us over many decades that that's not the case. It's an emotional thing, and it's also something that the industry has trained you to believe that you need to do with your money. So and we all know what's coming next, right? It has to happen. Until it doesn't, because we thought it had to happen the last decade, and that is a change in interest rates. It's got to happen. The Federal Reserve, in this case, needs to lower rates. Back 10 years ago, remember, every year we'd wake up and they say, oh, rates have to go up this year, and they didn't for a very long time. So many of you have been asking, okay, rates are going up. First of all, don't use going anywhere. Say gone, because it should always be past tense. And we don't know for sure that rates will change in September. That's the anticipation. I asked our trading team today, and they told me the market has already sort of factored in a reduction of rates of about 0.5% in September. And many of you said, well, with that approaching, what do I do? What should I do differently? And of course, you know our approach is going to say with your portfolio, absolutely nothing. But there's something to consider here that may be important, because many of you hold a lot in cash. And cash should only be used for short-term things. If you're going to buy something, if you have anticipated expense or college or any of these things, that's a place for cash. But otherwise, it should not be a part of your portfolio. I see many of you do. Many of you have just lacked the initiative to move money out of banks. There's still like $18 trillion in major banks making nothing. But for those of you who are smart enough to say, I'm going to keep this in cash and I want to make sure I'm making something on the money, this is going to be a changing environment, right? Because high yield savings account, for example, if rates do go down very quickly, those rates will change. Right now, you can still get around 5% for high yield savings. I would anticipate they go down maybe even as much as a full percentage very, very soon. But what about certificates of deposit? Because those longer term rates, the 3+ years, have been coming down. You can only get like 3% or so in those, but the shorter term are still a little higher. If I had money that I knew I wasn't going to use for a year, and I wanted to make something on that money, that might be something to do today, to look at those certificate of deposit rates. And you can go to wetrustbankrate.com and see what kind of deals you can find there. They generally have the best rates, because those yields should be at a level ahead of inflation. We don't know how that may change. But that would be something to consider, and lock that in now before rates do change, because once they do, then obviously their CDs will be right behind them, and they will reduce those rates as well. So that's something to think about. There's all kinds of other suggestions what to do with credit card debt. You know, we're always going to tell you to pay that off. What to do with a big picture purchase. We've said this many times. Your living situation should dictate when you're going to make that big purchase, not interest rates, even though it could come into play around getting a mortgage or around refinancing. Refinancing should get better in the years ahead as rates come down. Although in our meeting again today, our trading team pointed out that even if rates change, the expectation is getting back to normal would still only be like in the 3% range. So we're not going to go back to that zero thing we had 5 or 6 years ago and did have for several years. So again, rates could change. What should you do? Nothing in your portfolio if it's properly built for stocks and bonds. In the shorter term cash situation, yes, this could be a time to lock in those CD rates. And then you may have to be, if you don't, looking carefully at who's offering what when rates do come down in terms of those high yield savings accounts, because they're going to vary. And the word is there that we use is reinvestment risk. You could face the risk of those rates changing very quickly and going down and you're not making that money. So, but in an overall sense, if you call me and ask me, I'm going to tell you it doesn't matter what's going on with those rates because your portfolio is about you. And I would hope that my guest on the program today would say the same thing. I think she would. She's one of our advisors. She's been on the podcast before. Always a pleasure. Roxy Butner, thank you for running down the hallway and joining me here on Talking Real Money.
Thanks for having me. We have some great questions today. We
really do. And again, you can ask your question by simply going to talkingrealmoney.com. You'll see it right there in addition to update on Don's trip, which appears he may be stuck at the Casa de Tom Cock for a while here. We'll see how it goes. But he's there. It's fun. And he's helped me clean up a few things. Not literally, although Debbie has actually helped me clean up a few things in the house. So it's good to have them. But these are questions we get at talkingrealmoney.com every single day. Please feel free to go ask yours and we'll answer them hopefully in order. We don't answer all of them. Some of them are too much like, here's my portfolio, here's 97 funds, how do we do? And some of those I try to answer privately for you. We try to answer everybody, but some of them get on the program and some do not. So let's go to the mailbag. What do we have today?
Awesome. So we'll start with a shorter one here. It's from Joe in Wayne, New Jersey. And he says, my mom recently inherited some money and gifted some to my wife and I. We have one car payment with a 1.99% interest rate and our mortgage at 3.25% with about 25 years left. The money would be more than enough to pay off the car. We're wondering if you suggest paying off the debt or investing that money instead. We are both 30, have about 4 months of cash emergency savings, and have about $600,000 invested in retirement and taxable accounts.
Wow, Joe, you're off to a great start. 30 years old and you have $600,000 saved.
That's amazing.
That is totally awesome. Young people that have saved that much, that's terrific. So because you have done that, I probably would say go ahead and pay off the debt, even though it's low 1.99. I would not pay off the mortgage any faster. The car payment thing, make that go away. I guess he is asking about paying off the mortgage earlier. At 3.25, no, that kind of meets my, I always look at it like anything less than 5%, probably okay to keep the debt. Over 5% gets to be too expensive. So I would go ahead and make the car, pay that off. Keep making your mortgage payments regularly with those 25 years left, and then take the other money, keep your emergency savings, and then have the other money invested for the longer haul. But what's your take on this, Roxy?
I 100% agree. Get rid of that car payment. It's probably not even that much, and so it's probably just going to give you some nice peace of mind. But 3.25% on the mortgage, hold on to that.
Yeah, I mean, that's a good rate. Is it a great rate? No, you could have gotten a little lower than that when things were really crazy. I think the mortgage that I'm walking away from is like 2.4 or something. Okay, that was very cheap money. I got to get over that. You got to get over that. But 3.25 is great. And again, at 30, you have so many years of growth there. So that's another thing to think about, Joe, would be where to save that money, because this is another one that comes up a lot about should you put the money in traditional IRA or 401k, Roth IRA, 401k, or HSA. That is worthy of discussion and something that I think we'll get to. So, but I would be at 30, I would be trying to plow as much of that money into the market and plow it into the after tax, if at all possible.
Mm-hmm. Absolutely. Okay, another question from Roxanne in...
No, are you putting me on here?
Roxanne in Wahlberg, Texas. She asks, I'm typing this in because I know Tom likes to read the questions on the air. Would it be better to contribute 17% to my Roth 401k, currently at $52,000, or 7% to my Roth 401k and 10% to the employee stock purchase plan? What we know, I'm 68 and a half and want to retire at 70 and 7 months. So I have 1 year, 9 months, and 27 days to retire as I write
counting?
This.
I mean, really? I mean, I'm getting close, but I don't do it that badly.
She has an app for that.
Oh, okay. That's what I'm missing. Okay, good.
She says her Roth 401k is currently at $52,000. Company match is 100% up to 6%, which is a great match. I work for Apple, so that's what the employee stock purchase plan is. I have $1.4 million in a traditional IRA, $219,000 mortgage at 2.5% on a $767,000 house. Monthly Social Security should be at least $5,000 when I'm 70. And I would like to do more than 17%, but that's all I can do for now. I played around with the numbers and came out about even, favoring the 17% in the 401k by a couple of $1,000, but my math could be totally wrong.
Okay, but let's go back. I mean, because before you even get to that question, Roxanne, you got to have a plan in place when you're 68 and a half, because one thing you didn't tell me here is how much money you need to take out of any of these things when you do retire. I have no idea from all this about how big a deal it is going to be either to have money in a Roth. You said you have 1.4 in a traditional IRA, Social Security at 5, which is a great benefit, but I need to know that number first. What are we trying to work toward? But I'll tell you, under any circumstance, I do not favor owning company stock, the employee stock purchase plan. Here's why. Individual stocks have far more volatility and far more risk because sometimes they go out of business. Yes, Apple's a great firm, but so was Enron and so was Washington Mutual, right? Those were great firms too. And so I would rather see that money under any circumstance go into the 401k. And by the way, if you buy company stock, think it through a little bit. You're counting on that company for your employment, but then by buying the company stock, you're counting on it to be there for your retirement too, to fund that, which I don't trust. So I guess rethinking this under any circumstance, I would still urge you to do a couple things. Number one, to write the plan, to say, here's how I'm going to create income, which brings me to number two, knowing what that income needs to be, which this is going to be something I'm going to talk about at Retire Meet East coming up here in a couple of months back in Connecticut. But because until you have that number, until you can really say, here's what I'm solving for, you don't know. But even under either of those circumstances, I would not be recommending buying or getting that employee stock purchase plan. I would still put it into the 401k. But what say you?
Yeah, I mean, a couple things to note about an employee stock purchase plan in general. So basically, this is where the company offers stock at a discount.
That's correct.
Up to about 10% or $25,000 a year. Which
is the thing people, I'm getting this at a discount. Yeah, you are, but there's variabilities in price, and you may be overpaying because when the strike price is there, there's all kinds of variables there that may or may not work to your advantage when it comes to that price reduction.
Absolutely. And then, this is after-tax money that basically will come out of your pay, go into a separate brokerage account in a taxable account, and then you will have to pay capital gains tax on it if you hold on to it for more than a year. If you decide in a year to sell the Apple stock, then you actually pay ordinary income tax on those gains.
That's an important thing to remember. That's very good. And by the way, since you're 68 and you're retiring in a year and a half or whatever, how many days it was, that could come into play because you may get there and need that money to pay one bill or another. So good point.
Absolutely. So, I mean, you're taking on some additional risk if you do individual stocks and you work at the same company, as Tom mentioned, but also being so close to retirement, a year and 9 months away, the question really is, why are you taking on this additional risk if you don't need to, which is where the plan comes back into play. So, with $1.4 million in your IRA, you've got $50,000 in your Roth 401k, so you must have just started kind of saving up on that. I would want to build up that Roth bucket as much as I can, and then you have, tax-free growth for the rest of your life, essentially.
And think that through just in a general sense. Let's just say you have 1.5 between the two. You could draw $50,000, $60,000 a year from that bucket while getting Social Security of another $60,000. So now you're at $120 to pay the bills. I don't know how much that is because you didn't give us that number, but that's in a general sense would work. So again, I love what you just said there. Why take risk you don't have to take? Because if you already have the money you need for retirement, why are you messing around with this? This is a good question though, because around owning individual stocks, because we run into a lot of you that like the gamesmanship of it, and I've researched this, and Costco's a great company, et cetera, et cetera. I find it fascinating because I used to cover all these companies when I had a television show in Seattle. I mean, I got the research, I interviewed the CEOs, I knew the whole thing, and I didn't trust it. It made me nervous knowing all the things that could go wrong. But if you have to do it, I would make this point. I would not have my retirement be part of that, because that should be the nest egg that's going to get you to retirement. If you had other money and you said, hey, the future is going to be so great for fill in the blank X company, then maybe 2, 3, 4, 5% of your money does that, but not that retirement money, because that's the money that's going to finance you walking out the door, saying goodbye and never looking back, right?
Yeah, absolutely. I mean, I tell my clients all the time, if they want to have a little fun account, which is what they call it, that's where you can gamble a little bit. Because at the end of the day, investing in individual stocks is more of a gamble than investing for retirement with a, well-balanced portfolio. So.
No question. So, and congratulations on your retirement, which I guess this was written a couple weeks ago. So now you're down to like however many hundred of days less. So, I mean, this is really exciting for you, but you get close. I find that fascinating as well. So good for you. I think that's great that you have a date. I mean, and the only other thing I'd recommend for anybody retiring, and I will mention this at Retire Meet East on I think it's the 20th of October, having a purpose, knowing something that's going to engage. Right now, it's my house is going to engage me, but after that's done, whenever that is, you got to have that purpose. So I'd be thinking a lot about that as I closed in on retirement. What things are going to keep you going, get you up in the morning, and get you out the door to do something? Important to know.
People really don't talk about that enough as you approach retirement.
They
actually
do not.
So great point. Okay, next question is from Jenny in Indiana. Why can't I say that? Indianola. What is that?
I'm trying to find
Indiana. There we go.
Okay, good.
That's a tongue twister there.
Indeed.
Okay, this is, let's see here. My husband and I are 59 and 60, retired early on December 31st, 2023, due to good savings and recurring health issues. We are evaluating options to build a new ranch/elderly accessible home. Our background: we have no debt. We rolled 401ks of $2.1 million to Vanguard IRAs, $100,000 Roth IRA also at Vanguard, $38,000 in savings at our local credit union. We've got medical insurance premiums running at $2,000 a month until we reach Medicare age. So in 2023, we expect to withdraw about $100,000 from the rollover IRAs. We will also receive combined pensions of $41,000. Won't start Social Security until later. We need to downsize from 3-story house to a single-level ranch to accommodate our aging process and health issues. Yikes, current housing market is expensive.
Exactly. Yeah.
Question is, we plan to build a new home. We will need to finance or withdraw $175,000 to $200,000. What is the best approach? Take the full distribution from IRAs this year, or finance after shopping for best terms for a few years and split the distributions over 2 to 3 calendar years, or any other ideas?
Yeah, this is a really good question, Jenny. Thank you. Indianola. Yeah, that's kind of hard to say, but this is interesting situation to be here, because at 60, I struggle a little bit with starting to pull money from your retirement accounts because that's early. I mean, that means they got to survive for hopefully 25, 30 years. So that's a long time. But I would look at what my financing needs in total, and they kind of have it between 175, 200. So the savings would be the first place, because the taxation rate's going to be far better there than it is on the qualified money, right? The IRAs. I'd love to leave the Roth for as long as possible too, to get that tax-free growth. But I would want to know the rates on anything I'm paying to pull from savings, the IRA, and then we've already talked about Roth. And at the very least, I would consider the financing just to see what that would cost you. Because if you end up scraping together, just for sake of argument, half of it, and you only have to pull 100 from somewhere else, and if you have to finance 100 at, 7-8% today, maybe that still makes it worth it, because the money you have to pull from the other accounts, you're going to have to pay regular income tax rate on. So I might still say, yeah, that might be the better option, but I don't know, because I don't know what that actual cost would be. Is money more expensive today than it was? Absolutely. Is it painful to pay 8%? Yeah, it is. But in your case, it might work. And that's the other thing. You could do that and maybe keep that note for a while, and then let your portfolio grow a bit more here, because you are retiring kind of early, and then start pulling that a little later to pay that off later. And the other thing you don't really mention here is how big a deal it would be to have financing. If you had to finance $100,000 at 8%, how big a deal that would be on your household budget, which is something to consider as well.
Yeah. I mean, there's kind of two parts here. You can obviously look at basically if you pull it from your IRAs, you're paying taxes and compare how much you're going to be paying in taxes versus the interest that you'd be paying on some loan. But then again, this is always back to a plan. This is a cash flow situation where
exactly,
we're pulling $100,000 already from the IRAs. We haven't hit Social Security yet. Is that feasible over the next 30, 40 years of your lives? And is that number going to increase because you have a loan that you now have to pay down? So looking at all those factors in the long-term cash flow of your life will be really, really important. But if we just look at kind of tax rates and where you stand, I mean, you have $100,000 that you're pulling from your IRAs already and about $40,000 in pension income. So combined income of about $140,000. You're in the 22% tax bracket currently.
Yep.
If you were to take an entire $200,000 out of your IRA this year, 2024, you'd have $350,000 in income.
That would push you way up to what?
32%.
Wow. So one out of every $3 you're pulling out of that IRA going to the government. That's expensive.
Yeah. So another alternative, we probably wouldn't recommend that option there. Obviously, financing would be a little bit better than doing that. But another alternative is maybe you've got a little bit of flexibility on the timeline here. Maybe, we're almost closer to the end of the year.
So you
maybe
could straddle the year, do some in 2024, some in 2025.
If you do $100,000 each year, 2024 and 2025, you'll only be jumped up to the 24% bracket.
Now you're killing me here. So now you're making me rethink this. I really now think the financing for at least part of it is going to make sense because that's just a lot of money in tax. I mean, one out of every $4 that you saved, invested, and grown is going to be handed back. That's a lot.
So, I mean, those are your two options if you really don't want to finance and you want to pull from your IRA. Of course, it always makes sense to try and distribute it over a few year period. But even if you do the financing and, you're getting charged 8% a year, you still have to have a plan over the next 2-3 years to pull additional money out to pay for the loan and also to pay off the loan if you want to pay it off. So I think it really depends on your long-term plan. Another thing to consider, which lucky for you guys, you're 59 and 60. So we're not worried about Social Security because you haven't taken that yet and how that's taxed. And we're also not worried about IRMA because there's a 2-year look back and those are your Medicare premiums which start at age 65. So I would do something before 63 so you know that it's not going to affect either of those things.
Yeah, maybe the financing too sort of puts off the pain because then you can make a decision later about where to take the money, pay attention to the taxes, pay it off a little bit over time.
Yeah.
Again, I'm liking that more and more, even though the cost of that money is probably going to be in that 8%.
Yeah. And then you can also project what your RMDs are going to look like. You've got over $2 million in your IRAs. And look at that, pro and con analysis, because at the end of the day, if you're going to be pulling a ton of RMDs later on, then there could be an argument that might as well take the money out now and use it.
And use that now. And you're also going to be great candidates with the early retirement and all that money in pre-tax for Roth conversions at some point. You said the operative word here, got to have a plan because that would be playing into that whole plan to look at. This is the part that people have a tendency to forget. They've been good savers, as they have here in this case. Taxation, because it's your real partner all the time, but especially in retirement in many unexpected ways. You mentioned taxes on Social Security, which has been in politics here the last few days. So these are things that a good planner will definitely look at.
But I definitely wouldn't take it all out in 1 year at 32%.
That would be really very painful. So good advice there. And check on that financing, see what that would cost. Yeah, that's fair enough. We just got time for one more?
Yes, we do.
Okay, let's slide it in there.
Okay. Well, this is from George in Uxbridge, Massachusetts. And his question is about HSA or Roth. Hello, Tom and Don. I enjoy your show very much. You guys and Clark Howard are my major source of financial information. You are definitely more entertaining. I appreciate...
let's not pick on Clark. He does a great show, and he's been a big help to us. So
he says, I appreciate what you do for us. But I'm 60 years old and semi-retired. I have $500,000 split between Roth and traditional IRAs, $1.2 million in a brokerage account, and $35,000 in an HSA. I've been contributing to the max to my Roth for many years and contributing the max to my HSA since I discovered the triple benefit a few years ago. Now that I am semi-retired, I will only have the funds to contribute about $8,000 for retirement. Should I fund the HSA or the Roth or split the money between them?
Now let's talk about the tax benefits of each one of this. He mentioned the HSA, the triple benefit. people have a tendency to forget. So because an HSA, when you move the money in, reduces your current income, correct? It also grows tax-free and then can be withdrawn tax-free. Now, you have to have the medical receipts. I have a big bag of all these medicals that you can offset. So at some point I can say, I need $5,000. I'm cashing this chip in. Give me my $5,000. So there's a lot of advantages to putting money in the HSA. The Roth, on the other hand, there's no tax break for putting the money in the Roth. That goes in after you paid taxes, but it does grow tax-free and can be withdrawn tax-free. So it doesn't quite have as good a benefits. It's a little different. In this case, because it's the $8,000 and let's see, you have $500,000 split between Roth and traditionals. I'd probably just go with the HSA to reduce your current income. But again, we don't know what rate of your income tax is today, right? That's going to be the operative thing, because you're going to have the and you didn't give us the specifics on the Roth and the traditional, how much in each one of them. You're going to have a lot of great options here, George, in retirement, because due to the fact that most of this money is in a brokerage account, it does not have to be withdrawn on any schedule. It's going to earn a lower tax rate, at least under today's tax policy. It gets a lower rate than regular income tax. And now you're going to have Roth, traditional IRA, brokerage, and HSA to draw on and sort of play the tax rate game, if you will. So I'd probably do the HSA, but I don't think I'd be standing on ceremony either way. What say you?
I agree. I think you could go either way. I think there's an argument for either one. I think in general, because of the triple benefit, if you do think you'll need it for medical expenses, then go ahead with the HSA. Plus, you only have $35,000 in there right now, so build that up a little bit. But there's an argument that, of course, if you don't use it for medical, then what happens is if you need to use it for other expenses, it is taxable as income, just like an IRA would be. So in that case, it would have been better if it was in the Roth. So I can see both sides, but
it's kind of tough.
But I do think that going with the HSA, because there's $35,000 in there, you've already got $500,000 in your retirement accounts and $1.2 million in the brokerage. I think that's a safe bet.
Yeah, there's a few moving parts, and it kind of gets back to what you said a minute ago about having the plan. Because if you have the plan, then it's going to be easier to see, right? Where you're going to draw that money, where you want the faster growth, right? How to invest each one of them, those should be different. But you sound like you're in a pretty good place with the big brokerage account, money saved pre-tax, money post-tax. That is the kind of flexibility in retirement that is often overlooked because then in any given year, you can kind of say, here's my bracket. I don't want to bust that, et cetera, et cetera. So that is really good advice. And congratulations on putting all that together. I think you did a great job, as always. Good questions, good answers, a lot of interesting stuff here.
Yeah, people have great questions. It always surprises me, honestly. I love it.
Well, thank you for your time. Thanks for joining us. Roxy is hopefully going to be on another podcast here soon if I can figure out how to hit record on the computer. And Don only had to help me once this time. So any rate, I think I mentioned Retire Meet East coming up here very soon in Glastonbury, Connecticut on October 19th. I said the 20th. It's a Saturday. It's the only time that we will be in the Northeast, Don and I. And there's some great other speakers. Yes, we're going to do Retire Meet back out here in the Seattle area in February, but that's a different event, different speakers. Learn more by going to retiremeet.com. I think there's still a few seats left. They have a limited number in person. And then if you can't make it in person, we're going to be streaming this throughout the entire world. So retiremeet.com. You want more help? Want to talk to somebody great like Roxy? Well, that's easy too. Go to talkingrealmoney.com. Click on Meet an Advisor. Yes, we've talked to many, many of you, and we love it. We're happy to do so. Make sure you're on the right path. And Roxy, again, thank you for being on the program.
Thank you.
Always a great job. And again, our job here is to help you do better, worry less, have more money, enjoy your life, and not sit around and cogitate on money. Instead, let us sit around and talk real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.